about Aramco. One of the world's largest companies has come out with, well, one of the biggest numbers when it comes to performance in Q2. It made $30 billion, but that is a fall of nearly 40% for net profit, that is, in Q2 compared to the year before. To put it in perspective for us is the lesser spotted Matt Stanley of the energy data company Kpler in the studio. Morning, Matt.
Hello. Sorry, my electric vehicle broke down. Use petrol, people. Keep that demand going.
Righty. So
He talks the talk.
we've got Saudi Aramco seeing a 38% fall in Q2 net profit. The question we're asking this morning, one of them is this just a story of oil giant makes less money on lower oil prices?
It's $330 million a day profit. It's not bad. When you put it into context, like you said, I heard you saying earlier on, it's more than Exxon, Total, Chevron combined. It's 10 times higher than Shell. It's good. And yeah, of course, look, the very dynamics of how Aramco make money are to do with the fluctuations in the oil markets, energy markets. And that is off linear with how their profits are reflected. It's a story around flat price. It's a story around voluntary production cuts. But yeah, in essence, what you read so far is rings true.
Okay, well, let's tell that story then. In order to understand these earnings, we need to go back a year, don't we? We need to look at where we were in Q2 last year, which was a very interesting place indeed.
Yes. Yeah, I mean, look, if you go back 3 years, what's happened with certain issues within the OPEC group, if you look what happened with COVID, negative oil prices, it's been a tumultuous few years, but Aramco have been the de facto OPEC leader and have brought the OPEC Plus group together. So that was one dynamic they've always had to consider. And then you look at something from a political front, which you had last year with the Russia's invasion into Ukraine. Europe, there was a massive energy security issue. Crude oil prices rallied up to $140 a barrel. Gas oil, which is the EU's biggest industrial use fuel, or diesel fuel, that spikes on the back of it up to $1,400 a tonne. That now is in Q2 is below half that. So yeah, it's all reflective. It was an energy security issue we had last year. That has stabilised and prices have adjusted accordingly. We're back down to the half of where it was.
Yeah, and if we look at the quarter that these earnings have come out of, we were between sort of $74, $75 and $84, $85 a barrel for the quarter. Now we are this morning sitting at around the 85 mark. We've got Saudi last week saying that it's going to be expanding those voluntary production cuts into September and that it could continue to do so, that it could even go deeper. What does that mean for Aramco?
Well, it's at the peril of its short-term income comes long-term gains. And Aramco are looking at things, the Saudi government are looking at things from an OPEC point of view in order to balance markets, keep prices at a level of around 85, which we think their fiscal break-even is around $86 a barrel. So a level around here is consistent with what the energy minister, what he wants. They've got one eye on demand. Demand, I know Tom just mentioned that, if you look at the Aramco report yesterday, the 2024 forecast is good. Short term, look, second half was going to be amazing, and we're in the second half now. It's not great. We had Indian crude oil imports from Saudi Arabia down to their lowest since November 2014 last month. That's a story about where they can source alternative supply, but it's one. The group itself, the very reason for its existence is to balance demand and supply, and Saudi Arabia certainly look at that and then drive forward when they come to these meetings on a monthly basis. The JMMC meetings. So look, it's the reason that flat price is up here is mainly a supply issue, one that's been voluntarily cut because demand is okay, but it's certainly not as many forecasts it would be as good as it would be for the second half this year.
Okay, well, let's look at that forecast for the second half of this year, much of which hinges on China. I'm hitting refresh this morning, waiting for some Chinese trade data. It seems like every day at the moment we're either looking for jobs numbers out of the US. I'm a fun person, Matt. Jobs numbers or inflation out of the US, or we're waiting for Chinese data, which so far this year has pretty much disappointed. What happens to demand for oil if it if the Chinese economy, if domestic demand doesn't pick up?
It's an interesting one, actually, and I'm sorry I was jesting, I was mocking with you, but I was in Singapore a couple of weeks ago. You know, the demographic there in the last 2 decades has certainly shifted more towards the Chinese one, and it's one of caution. You know, the whole Chinese population, the middle classes, the younger generation that's now coming through is certainly one that's a lot more cautious than the predecessors have been, and I think that's reflected in oil pricing. I think people are, you know, some of the guys, my colleagues, kids. You know, I'm an old man; they call me a veteran. You know, fair enough. They'd much rather sit at home and sort of play video games and make sure they're going to earn some money and keep it in the bank than they would go to Thailand on holiday. So it's you know, I'm the other way, but it's certainly reflective on what it means for domestic fuel demand. So you know, you can't really buy a car in China without it being electrically powered. Don't, after my experience this morning, exercise caution. But it's got to be reflective in oil demand. And will it ever get back to the legendary pre-pandemic is the adjective that people love to use? I'm not sure it's relevant. I think that it's just all that COVID really did was accelerated that sort of change in end user demand. It has disappointed. The thing is, it's been balanced out by what's happened with a fairly soft landing in the US. Many people priced in recession, and we haven't seen that.
You mentioned demand there, and so did the earnings and the comments coming around the earnings from Saudi Aramco. As normal, we saw a call to keep investing, their capital expenditure, to say, look, we need to keep investing to safeguard energy security. Do we have a potential supply issue or not?
No, I don't think we do. I mean, look, it boils down to a much bigger macro question, and that is there investor appetite in fossil fuels? Now, we've touched on this in the past. In Europe, no. You're not going to get you're not going to go to Barclays Bank and say, other banks are available. You can I have £100 million, please, to go and drill an oil well in the North Sea? It's not going to happen. But if you're part of a wider generic investment plan within the GCC, for example, banks are willing to get involved. And that's reflective not just in Aramco, but with ADNOC, bringing forward zero carbon to 2045, 2030 oil supply to 5 million barrels a day. So I don't see supply as an issue when we're seeing the GCC really accelerate that growth and supply.
Okay, 30 seconds left with you. What do you see in terms of prices? Where are we going?
Look, I know lots of people are saying that they see it going higher from here. I think we're at about a Goldilocks level. 85 is pretty good. I think that Q3 will be quiet because everyone's in the Costa Fortunes on holiday.
Fighting for sun loungers?
Yeah, exactly. Q4 could be... look, again, it comes down to the gas story. Everyone's got to watch what happens with diesel prices. They went up 7% last month. I think they will go even higher next month here within the UAE, and that will be reflective across the whole energy complex, but pretty much where we are now.
Our energy expert this morning, Matt Stanley of Kpler, thank you very much for your time.
Dubai Eye 103.8.
Join the conversation.